I guess just for business owners out there, if you have never had a valuation, it's not an inexpensive thing. I definitely will put that out there. But I think that, no pun intended, the value you get from it is really, really high because if you have no idea what your business is worth, how in the world are you going to plan for anything? I mean, it's the ultimate mark of how successful you are, that value, because you've got to be able to grow the company and be strategic in the run, but also be operationally, on top of your game. So if you haven't had a valuation, I think you should really think about it.
Welcome to the Cashflow Chronicles Open Forum. I'm Matt Allison, a commercial insurance advisor helping businesses protect their cash flow by managing risk and putting the right protections in place.
And I'm Brad Metzger, a commercial lender specializing in finance solutions. From lines of credit and term loans to real estate mortgages, I'm here to help businesses grow and stay flexible.
This podcast is a community-driven conversation for CFOs, finance leaders, and business owners who want real insight into cash flow, credit, and financial resilience.
We keep it practical, collaborative, and to the point.
Powerful finance conversations in under 40 minutes, built for busy professionals. This is the Cashflow Chronicles Open Forum. Hey everyone, welcome again to the Cashflow Chronicles Open Forum, where we feature various experts in their fields, talking more in depth about specifics in their industry, as well as being able to get to know them as persons as well. Happy to have Sarah Greifenberger on this episode. Sarah, welcome.
Thanks.
Walk us through a little bit about your work at Arbor Valuation and what you bring to the table.
Sure. Well, first of all, thanks for having me. Arbor Valuation is a company that I started, right before the pandemic, honestly. And what I focus on is valuation of privately held companies, lower middle market. So typically the firms have revenues between $5 and $100 million, something in that range. And these are more often than not companies where the owner is starting to think about an exit. But I also do probably about a third of my business is valuations that are used for reporting gift and estate tax to the IRS. So this could be somebody's giving juniors some shares, or it could be a very wealthy person is moving, 1,299.5 Class B non-voting shares into a trust. It's all over the map with that. But when there's gifting of any sort, there has to be a valuation involved in a privately held company. So I do a lot of work in that arena. And then, there's a lot of one-offs, like two owners or more than one owner, and somebody's getting bought out. A lot of times I'll be brought in to do an independent valuation for that buyout. It could also be that there's a buy-sell agreement in place that requires an independent valuator to come in. I don't do a ton of bank-related valuations, but I do some where, it's required for lending. So it's kind of all over the map. What I don't do is I don't get involved in litigation. So there are a lot of people who are in my business who get hired in divorce cases or in business divorce cases. Anytime there's a privately held company involved in a dispute, it usually requires valuation to determine what the value of the asset is. That's the type of work that I avoid because my motto is life's too short to be involved in other people's problems. So, and I'm pretty industry agnostic. The one industry I don't do a lot in is healthcare because it's sort of niche in our world and it requires certain databases. So I'll peripherally get involved in it. Like I've done mental health practices. I've done some dental offices, but not like I wouldn't do a surgery center, for example. So that's kind of it in a nutshell. I absolutely love what I do because it gets me out and about, mostly in Michigan, but I do evaluations in other states as well. Get to meet a lot of fantastic business owners, hear their story. Generally speaking, people don't get a valuation if they're performing badly. Usually people want to get a valuation because the business is good. And there's value there and they need to plan around that. So that's fun too, to see all the success that people have had in their lives, working very hard, the American dream, really.
Can you walk us through an engagement? For instance, what is it going to take to kind of take the initial steps and what it may look like as the process goes on?
Yeah. So my partners in Q5 probably get sick of me saying this, but I always say people don't wake up in the morning and go, today I think I'll get a valuation. They need evaluation because something has happened either in their life or in the life of the company that is causing them to need to know what the value of that is. And often it's for very like kind of official purposes. And so, they'll usually call on the phone. A lot of times they'll go to their advisors. Who do you know that does this? And so I get a lot of just inbound phone calls from people who are in this position where they need evaluation. And I like to talk with that person on the phone for quite a bit because I want to make sure that they really need the type of services that I offer. I'll give you an example. I had a gentleman call me a couple years ago who had a very fairly large company down in Florida that did healthcare staffing. And, my initial reaction was kind of hot space. He's probably going to be able to get a lot more money for this company than what my valuation is going to say it's worth because I do mostly fair market valuations. And we'll talk a bit about that, what that means later. But I actually pointed him to different people because I thought they could serve him better in terms of understanding what I call crazy money might pay for his business. But I do have this long conversation with the person on the phone to make sure that it's what they need. And then generally it is because we talk through it. And then if they're ready to go, I usually give them a quote right there. I believe in flat fees. I don't even know how long it's going to take me to do a valuation, so I don't expect them to have to try to guess. So I just quote a flat fee. If they want to go, then I issue an engagement letter, and then we're off and running. We set a launch date, and usually it's about 3 weeks from the time. If I have all the information, it's usually about 3 weeks from the time that I start to the time I finish.
That's a big
Now I'm not
thing.
doing like one engagement after another. I'm juggling multiple at the same time.
The hardest thing is making sure you get all the information.
Yes. Yes. And that is really all over the map in terms of the quality. And that is the driver of the length of the engagement generally, is just not having all the information.
Yeah, as a banker, I understand. It's like, oh, why can't you make a decision? And it's like, I'm still waiting on information that kind of
Mhm.
completes my analysis.
Right. Exactly.
So if
Same
And
somebody,
thing applies
you
for
and I are looking
insurance.
for the same information for the most part.
we're all on the same page. We need your input
Yeah.
to make a decision. Got it. So if you have, if somebody's thinking about, I'll say selling, you talk about your process only kind of being, 3, 4 weeks, depending on information. Somebody's thinking about, I'll call it a succession plan. Is it 2, 3 years? Is it longer that it's better to get an evaluation on the front end and maybe on the back end as they are progressing through? When is a good time to, I'll say, engage evaluation if they're thinking about selling their business?
The minute they start thinking about it. I mean, it depends if they've had one before. Some clients have had evaluation before, some haven't. I would say the vast majority of my clients have never had their company valued, my exit planning clients. And oftentimes it's the owner calling saying, hey, I'm 70 years old. All I've ever done is run this business. I have no idea what it's worth. I have to come up with a plan to get out of it. I didn't even know what to do, but I figure understanding the value of it is a good place to start. And it is. Because what ends up happening is, people fall into different categories. So I would say, like, you want to be thinking about this minimum of 5 years before you want to have a transaction. And the reason is because if you figure out that that value is really quite different than what you had in your mind, there are going to be some huge implications in terms of personal financial planning, tax planning. So the more information you have up front, the better you're able to plan for that exit. It gives you time also to build more value into the business. So in a lot of cases, I've seen the value comes back. It's not quite what the person feels they need to get out of the business, and they put plans in place to try to grow value into the business. And so that's why the 5-year time frame is kind of a nice one. It seems to be sort of the standard time frame that most people have in their head when they call me.
I think just from personal experience with valuation, I'm sure you had some valuations where the owners come back to you and they're shocked on both sides of the spectrum. What would you say is the biggest misunderstanding that individuals have about valuation?
Well, it's fascinating because it's a cliche almost that the business owner thinks their business is worth more than it is. But you'd be surprised. There's actually a lot of owners out there who think it's worth less than it is. But to a person, the owner that thinks it's worth less than it is like an amazing business owner. Amazing. They're doing everything right. They're a student of their business and they just haven't gone through the process. So I've had shock on in both ways. And one of the things that I try to do with that owner that thinks it's worth more than it is, I do in our business what's called a detailed report. Most valuation folks will not be doing that. They'll be maybe doing what's called a summary report. It might be like 20 schedules or something like that. I do a detailed report pretty much every engagement. I mean, if somebody really doesn't want it, then I won't do it. But the reason that I do it is because I believe it provides full transparency. And I think it's especially critical in those cases where you have two owners. They obviously have differing interests in what they want that number to be. And somebody is always happy and somebody's always not happy. And so by being very transparent about the assumptions and the thought process that went into all of the different mechanics within the model, it cuts down on that ability of the person who's unhappy to say, well, that's a bunch of bunk. She doesn't know what she's talking about. Well, it's very detailed how I arrived at each thing. For example, I'm not going to throw out an estimated growth rate in a model without a tremendous amount of backup. How is that supported by what's going on in the economy, in the industry, the historical performance of the company, plans that are in place for the future? So by being very detailed about what's in the model, it cuts down on that, and then once they get over the shock, I always offer to walk people through the report. You'd be surprised how many people do not take me up on that, which is a shame because it's like free advice after you've already paid for the valuation, right? It's free advice to understand what drives the value.
What are some key metrics that you feel can move a valuation either up or down?
At the end of the day, there's kind of two concepts that drive value: cash flow growth and minimizing risk. All right. So those are the key things to think about for any business owner. How do I grow cash flow long term cash flow growth in the business? And how do I minimize risk? And so depending on, every company's different, and depending on what's going on in the company, you have to get at how you do those two things and measure the things that drive you to cash flow growth and minimizing risk. So, and it's going to be different for every company.
I think the benchmark is always EBITDA, which is always the variable. How important is EBITDA growth versus quality? Is that something you come across at times? Because EBITDA quality is somewhat of a variable that you can't objectively monitor.
Well, pretty much every engagement, the notion of EBITDA quality comes up, right? So these are
Yeah.
privately held businesses and it's all over the map in terms of what's running through the financials. And so the most common things I see are that require analysis and taking an extra look at it are owner's compensation and rent. Generally business owners that are running an operation out of a building will own that building in a separate company. So then you have to, so I'm not including the value of the building in what I'm valuing if I'm valuing the operating company, but I have to look at the rent that's being charged or the lease rates and make sure that they appear to be at market rates. And generally they're not. Generally it's like, what? So, those are things that require adjustment. But, I will sit down with owners who have too much running through the P&L. I'll sit down with them after the valuation. I'll say, look, I am giving you credit by adding back some of these excessive expenses, cruises with the family or whatever it is that you come across.
It's a business expense, right?
Yeah. Well, in that case, they had 3
Marketing.
adult children working in the business. So it was like an offsite. But anyway, I don't know. The grandchildren were all there. I did adjust for that. So, I'm going to add back. So in other words, the value is sort of giving the owner credit that, okay, these are personal things that a hypothetical buyer would not be spending money on. But that being said, I have a little talk with the owner about, okay, you're 5 years out from wanting to transact. Guess what happens when you're getting like 2 years out, 1 year out, and they look at these numbers, you may not have a buyer that's willing to give you credit for this the way that I am. And, and then you might get into a situation where you've got to hire an accounting firm to do a quality of earnings and ka-ching, right? And so, it's much easier to sort of clean it up before a transaction.
What do you kind of see in this environment today, current conditions that are more or less affecting valuations?
Well, the environment comes into play in largely in building the cost of capital in the models. So, I'll go through and I'll do this. We call it a build up model. And it's looking at like it starts with, okay, well, what are treasury bills? What's the rate on those? And then you start adding in, okay, what's the risk that big equity companies like publicly traded companies have? And then you're adding in small company risk, industry risk. So you're adding all these things in. And what ends up happening is when economic circumstances and industry circumstances are off, let's say, or slow or soft, whatever the words you want to use are, it tends to find its way into the valuation through that cost of capital that's being used. So I could value a company a year later than a prior valuation, and just because the Fed changed the rates, my cost of capital is changing too. So that's largely how the environment is. And then obviously there's just environmental aspects of, can you grow your business in the environment that you're in? So you got to look at we look at growth into perpetuity, right? Which is a really long time, forever. You can't sustain super high levels of growth into perpetuity. So you have to come up with a reasonable estimate of what kind of growth the company can experience.
So a company that has been growing 20% in the last 3 years, that's
Yeah.
clearly not sustainable.
Right, right. So, and to that point, I don't do a lot of work on startups. Generally, people in startup companies, what they want is a 409A valuation, for stock options. And I typically don't get involved in that because it's sort of garbage in, garbage out. Like, you're basing the entire valuation on a forecast. I mean, like, could you have forecasted most of Silicon Valley's success stories if you looked at their forecast when they came out? It's really hard to come in and say, oh yeah, well that's going to happen or that isn't. Those are the companies that are a little harder to put values on.
Yeah, just think of startups. How many are great success stories, but how many failures are there as
Right.
well, which kind of comes into play with that. Because with technology, and you think about AI right now, so many things address common problems, but what does your business plan look like long term? You need the actual cash flow to use that from a valuation standpoint. What would you say is the common assumption about valuations from like a CFO financial leader versus reality, if you say it, in our current environment? When you come in the door, we know that this is what my business is worth versus reality. But in our current environment right now, what would you say is some assumptions versus reality that you've come across in our current climate?
It's interesting because I'm generally dealing one-on-one with the owner, and I may or may not be talking to the CFO of the company. So it's hard because I'd say about 80% of the time, the CFO is kind of only answering questions that I have. I'm generally dealing with the owner. So I don't have like a great data set to answer your question. But I
Okay.
find financial folks are typically a little more grounded in reality than some of the marketing operational owners and all that. So, if you come back with a number, the financial person is typically more inclined to like sort of, yep, 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 that makes sense to me. That's the experience I've had at least.
Well, I think they're just grounded in the numbers, so they see
Yes.
the reality. While most heads of companies are more the idea folks,
Yes.
and that could be a off base assumption, but perhaps that's your experience too.
Yeah, it has been. A lot of times it's, making sure you're talking to the right people and you have all the right information to even make a decision. So, and it depends on the owner and how involved they are on the finance side. You hope they are, but it's not always the case.
Well, and I'll tell you, how I talked about the owners that are the best owners, the ones that typically think that the company might be worth less than it is. those people to a person are always aware of their financials, always. So it is like there's just certain things, good owners are on their financials, they're tracking things, they're putting ideas in place for the future. Just it's every single time. I can it's palpable. I can almost tell when I walk in the door if the person's going to be happy or unhappy with or, whatever it is what it is. But that unhappy owner is the one that's generally disconnected from the financials.
So you have, let's say you have an owner that's, I want to sell the business, but I don't know how, so we're at year 5 out. Do you get involved? And they're looking at the options that they have. And one of the things that they do have is ESOPs. Do you get involved in kind of that process of evaluations for ESOPs or helping them decide if that's even a good option for them?
So the type of valuation that I do is what's called a fair market valuation, and that is absolutely the type of valuation that an ESOP would require. So I don't personally do ESOP work only because I've been able to just keep really busy with other types of work. The beauty from a valuator standpoint in valuing ESOP companies is that they require evaluation every year, which for anybody who's ever heard about ESOPs having more administrative costs, that is one of them. So the type of valuation work that I do could be used in an ESOP. So if I work with an owner and I say this is the value, that is what an ESOP would produce. That being said, there is one of the other reasons that I'm not involved in ESOP work is there's oversight from so many different bodies in that realm, the Department of Labor and so on. So, you just have to, it's really a business that's better conducted by larger valuation firms, maybe than a solo practitioner.
So let's talk about Q5. What is it and how are you involved with it?
Right. So, well, you had talked about the owner who's, trying to think about exiting the business. And I discovered early in my practice that I would come back to owners. I'd say, here's the value. We talk through it and everything. And then they're like, okay, great. I know what my company's worth. Now I have no idea what to do. No idea. So this happened enough that I started thinking, well, I would really like to have some service to help these folks get themselves further down the road toward a transaction. And that's sort of how Q5 evolved. I met Chris Cousins, who's the president of Financial Architects, wealth management company in Farmington Hills. And I was talking to him about this, and the light bulb went out for him because he had experienced his own issues when he bought Financial Architects. So we kind of got together and thought this out. We brought in other pieces. Now, Q5 in no way does everything that an owner would need because an owner needs so much planning up front. So, for example, we don't have an estate planning attorney that we would have to work and help them get the right person for that. We don't actually do investment banking. So, but we're connected with investment bankers that they could talk to and so on. So what we do is we're kind of upstream in the process where we're helping them get their ducks in a row. I run them through a mock due diligence. They get to know their value. What are the things we identify the things that they need to do over the next 5 years. And then we plug in another partner, Chris Messo, who's a strategic coach. And Chris works with them on those things that they have been identified to get them closer to transaction. And one of the key things that's part of getting ready that a lot of people don't think about is people. People are so critical to getting that company in the right place. I mean, is there a team in place that a hypothetical buyer can come in and hit the ground running with or not? Is everything dependent on the owner? And so these are things that have to get worked on, and is the team functioning well together? A lot of times the answer to that question is no. So we work with them on really getting their organization to be a really efficient, well-run company before they go and do that transaction. So that's a long-winded answer, but it's kind of, and we also work with them on the personal side, the owners, getting them personally ready to ride off into the sunset, or as we say, into the fifth quarter. So that's a big piece of it because a lot of owners have their sense of self-worth wrapped up in the company. It's all they've ever done professionally.
That's their
And
retirement. A lot of time, it's either they have a retirement or they've invested so much into it, they're just looking to get the maximum.
yeah, every owner's different as far as, and some have family in place, some don't. Most don't. Most of the time the kids want nothing to do with the business, but so it's all over the map. I always say every company's a snowflake because they are. The set of issues with each company varies. But after a while, the our team we've kind of seen it all. And so, it helps to have veterans who been there, done that. I've seen that before and, that can help owners work through it.
So you kind of mentioned families. Would it be safe to say that you're saving families one valuation at a time to alleviate any, finger pointing or how much is this business really worth?
Yeah. I mean, I just did one for a sibling who is, I'll call it the out sib. There were two in the business, one not in the business, and an offer was on the table to buy the other one out. That was a hard valuation because I couldn't exactly he wanted to keep things smooth and nice with the other siblings and didn't want to cause a stir. So it was like I had to, I got the financials, but it was what I call a scope limitation in that I couldn't talk to the people running the company. But at the end of the day, we got to the right place with that, which was that the offer that had been presented was actually a pretty good offer for him. So, and he's in an entirely different business. But it's interesting how, you get a lot of times you have like some siblings that are in the business, some not. And so creating something fair is always in the minds of the parents. And it's hard because the people running the business, they're the ones doing the work. You know, it's kind of a lot better if the person gets sort of bought out at an earlier stage and then let the people in the business run it so that they can reap the benefits based on their own performance and their own actions. Where I think people get into trouble is when you have this person who's never involved in it. And then you've got issues like either the ones in power aren't distributing money or the person's getting distributions that they didn't really have any part in producing.
Right. It's all too often you have family members that are involved in the business, ones that aren't. And the intent was to make sure that the kids get equal parts. Everything's equal.
Right.
And when they're gone, when the parents pass on, it's a commingling of assets. So you have like business assets owned by the wrong people, and it just creates a difficult exit. And again, that's why I said you can save families one valuation at a time to make sure that everybody gets a fair value on whether it be, the business side, which is harder to evaluate than, the real estate. But yeah, what is the family business really worth from all aspects? What's the dollar amount? And then, but you're right. The earlier you could do it, the better, because as time goes on, it just gets messy.
Yes, it does. And we're just working at Q5 with a family now that kids are the kids. The kids are very, they're young adults and it's actually really pleasurable to work on this because it's helping them all get grounded in the same information moving forward and and the parents can work with all their children are involved in the business and they get along really well. So it's a very unique situation, but it's nice to sort of work with them in such an early stage before the kids take it over because they're going to have so much more information than the average family member running a business would when they take over from mom or dad.
I think that's a really good point because we all work in the people business, understanding with respect to, hey, you've built this business for 40, 50 years. You have a lot of integrity and sweat equity with that business. How do we bring in the objective facts to navigate the data that's there from a financial standpoint and make it, I respect what you built, but let's build a plan to maximize this valuation the best way possible. And I think that's where that 5-year period comes into play too, where, hey, let's continue to fix these few things that you're working on, really to make sure that you're structured appropriately. You have a track record where it's not just since the past 2 years have been great. I mentioned that 20% margin. or sales increase, which is great, but is that sustainable? Because truly, as advisors, we want to see our clients succeed in the long term. So one thing I failed to acknowledge is you as a person, Sarah. So what got you into valuation?
Well,
Walk me through
I had
history.
a corporate life many, many years ago. I worked for United Technologies Corporation based in Hartford. Most people are more familiar with the brand names of the companies that were part of it: Carrier Air Conditioning, Otis Elevators, Sikorsky Helicopters, Pratt and Whitney aircraft engines. So at one point in my career, I was a director of financial planning at the corporate office, and I had a lot of different sort of things I had to do in that role, but one of the most enjoyable, honestly, of all the things that I did was valuing companies that the corporation was going to acquire. And I mostly valued companies for Otis Elevator. They're really well-run company, and there's lots of elevator service companies around the world. And so I learned how to do valuation there, and I had fantastic coworkers, that I could just pick up ideas and tips and everything from. And it was just a great environment to learn how to do valuation. And then I was a stay-at-home mom. That was my second career for quite a while. And I knew some attorneys, and I lived in Connecticut at the time. And the attorneys said, "Hey, you're an expert in valuation. You should go and become a certified valuator." And I'm like, "Huh? That's like a thing? Like that's a job?" And, they're like, "Oh, yeah." Now they were talking about it from the litigation standpoint. So after I got certified, I kinda took a look at that, and I'm like, I am not getting involved in people's divorces. No, thank you." So but then I realized that there are so many other reasons why somebody would need to hire a credentialed evaluator. And one of the beautiful things about starting my business is that, to be honest, there's just not a lot of us out there. If you put it in perspective, there's well over 1,000,000 accountants in the United States. There's something around somewhere between 10 and 15,000 credentialed evaluators. And I would argue that probably half of those people don't do a ton of valuation. They just got the credential. So, it makes starting a business a little easier when there aren't so many of us in the marketplace.
I think that's a good point because valuation, like, what is it? I'm not sure. What exactly does that? When we first met, geez, 3 years ago, I did a trade economic club event. I was like, well, valuation, like understanding with the masters and stuff, it's like, I get it, but walk me through the day to day life. I think it's something that having a trusted resource that knows what they're doing. Yes, they have the certification, but do they practice it on a daily basis? And I think you being independent is very helpful because there's no bias in your evaluations or anything along those lines.
That's one of the most critical aspects of being a credentialed evaluator is you swear an oath of objectivity. So I don't think I'd be in business very long if I let the values swing one way or another it doesn't work that way. And it's funny how many people think it works that way. I'm not going to say that people in a litigation setting can't be swayed a little bit but I don't have to worry about that because I don't have some lawyer beating me up over my number that, isn't going to help his client. I can come in and let the facts lead me where they lead me. And, a lot of times it's not my favorite engagement to work with two buyers. I mean, two owners and one's buying the other out because I'm a people pleaser and somebody's always going to be upset, right? There's nothing you can do about that. Somebody's not going to like the number. But I make sure that if one person hires me, I say, "Look, I'm not going to do this job unless the two of you sit down together with me and go through the interviewing process with me. It has to be fully transparent for both of you." And then I do this detailed report. And so, I do that all in an effort to eliminate that thought process. If somebody doesn't like the number, the first thing they're going to say is, "Oh, it's biased. Joe hired her, and so she did a number that, works for him." When I get the owners together, I say, "Look, Joe hired me, but I might come up with a number you love and he doesn't. So it's just the facts have to lead me where they do."
I think that just speaks to when you treat people with respect and your work speaks for itself, the business follows because it's just a matter of, hey, Sarah does great work. She's authentic and she's real in her work. I think that is something most people respect. Very transparent in the process. Like, hey, I may not be a fit for you. Here's my rules of engagement because it's fair and equitable. in that perspective. So kudos to you for doing that. So one final question for you, Sarah. Are you ready for it? This is the
Okay. I think. Should I be ready for it?
when you moved to Michigan from Connecticut, what was the biggest surprise about Metro Detroit that you picked up?
Well, the thing I didn't tell you, Matt, is that I'm born and raised Michigander. So I was born in Ann Arbor, lived here 18 years of my life till I went to college. Um, but Metro Detroit has been so much fun for me because I was from Ann Arbor, and when you're a kid in high school and everything, you've got so much going on all the time. You don't really have an opportunity to get out to Detroit too much. So my husband and I have just absolutely loved getting into Detroit. I'm in the Detroit Executive Association, so I'm there every week. It's just been a lot of fun. I love historical buildings, and there's so many of them in Detroit. There's so many great little things to discover. So, and in fact, I'm in this women's organization. I did a whole presentation on my discoveries in Michigan since I returned to live here. So it's been a great time since we moved in 2018, and I love getting out and seeing all the things again that I haven't done in years.
Just the vibe of Detroit, and being involved in the business community, it's just such a great ecosystem. If you're involved in the business community, it's so supportive.
It is.
If you're not involved, you're missing out because how can we support each other? And it's pretty compelling, the power of the network. It's like, hey, do you know Brad or do you know Sarah? It's like, oh yeah, I know them. I'm like, wow, that's wild how it works that way. I think it's in truth.
And you and I work in this, like, we all kind of work with similar types of clients. So it's like you go to a network event and like everybody in the room after a while because we're all kind of working in the same, as you said.
We're seeing you at the Detroit Athletic Club. I'm like, oh, Sarah, great to
Yeah.
see you. And then sure enough, John introduced us for the podcast. So it's just funny how that works. So in closing, what do you want the listeners to know and how can we help you all together? Is there anything you want to leave them with?
I guess just for business owners out there, if you have never had a valuation, it's not an inexpensive thing. I definitely will put that out there. But I think that, no pun intended, the value you get from it is really, really high because if you have no idea what your business is worth, how in the world are you going to plan for anything? I mean, it's the ultimate mark of how successful you are, that value, because you've got to be able to grow the company and be strategic in the long run, but also be operationally, on top of your game. So if you haven't had a valuation, I think you should really think about it. And if you are somebody who's had a valuation, just, like you don't have to do it every year or anything. I have some clients that want to just keep doing it every year, but every few years or so, it's great to sort of put something in the sand and see how you're doing relative to that. And why has it changed? How has it changed?
I think that's helpful because it's benchmarks. How are we doing versus our competitors in the marketplace? It's a great tool. And speaking from a banker standpoint, Brad, how do you guys evaluate valuations? Say valuation twice, but
I don't want to oversimplify, but EBITDA multiples are a lot of times a measuring point. We'll look at different industries and, because we have different levels of, I'll call it customers in different industries, we can compare them to each other and we use other benchmarks too. So, but there's something about a third party valuation that gives the warm and fuzzies inside that it's kind of independent and it's not, they actually dug into the actual financials. So there is a big benefit of having a valuation completed by a third party because, again, they're digging deeper into it. They're understanding. They're actually talking to the owner. So, but yeah, banks like valuations. It's a like we said, it's a line in the sand. Line in the sand is a point in time. Where the value is. So, but Sarah, I appreciate the time.
Well, thanks so much for having me.
yeah, thank you so much for joining.
All right, thanks.
Awesome.
Hey, you've made it all the way to the end. Thanks for that. Make sure you subscribe to the Cashflow Chronicles Open Forum newsletter, drop us a like, and follow us on LinkedIn and YouTube.